All right, here we go. We are live. It is Friday and we are live. So let's get started. Live in the interwebs, all the social medias, all the good times. All right, let's begin. Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm and I will be your host. And today I am joined with my good friend, Doug Hagren. Hey, Doug.
Happy Friday. Good to be alive and live today with you.
Cheers to that, Doug. I'm always happy to be alive. Although some days it doesn't always feel that way. So let's dive right in. So today, this is kind of an interesting week. We had we had a lot happen this week, a lot of data come out, and oddly enough, it is just in line with what we've been saying for like the last 12 months. And let's hope the listeners have remembered some of this, because we're going to talk about it a little bit today. So if you remember last year, we had been talking about how the market was not pricing the future interest rates properly. And for those of you who didn't hear those episodes, what we talked about is how the stock market is typically forward looking about 6 months approximately. So it's looking ahead 6 months and saying, all right, 6 months from now, here's what's going to happen. We're going to price that in today. So it discounts it today, what's going to happen 6 months from now. Okay. So if the market thinks that interest rates are going to be down 1% in 6 months, going from 5 to 4, they're going to price it in for 4. If they think it's going to be up, they'll price in for up, right? So it's all about pricing in what the future is going to hold. And that's why we have volatility, right? They're not pricing in what happened today. They're pricing in what's going to happen in the future. Now, can anybody tell the future? No, they can't. But the stock market is set up that way, so it tries to predict what's going to happen in the future. And we all know human beings are terrible at prediction. So I think the volatility is a good indication of that. Like, we are terrible at predicting the future. So what tends to happen is the market looks at the data and says, here's what we suspect is going to happen. Now, most times that's normal. Like, I guess we haven't had normal in a long time. I was trying to think of an example, Doug, but I don't remember the last time things were normal. But if we're looking at, let's say, a normal period where things are a little bit, they're not rocky, there's no wars in foreign countries, you know, they're not changing the direction of interest rates, just a average lukewarm bath kind of day, you'd have a lot lower volatility. Now, right now, we're in the midst of a lot of changes. We've got the war in Ukraine, which isn't changing much. I guess that's a static war, which is terrible, but it's, you know, kind of an expectation at this point that that's not going away. You know, you have a Middle East war between Hamas and Israel, which people speculate may get worse. It may not. Who knows? I have no idea. I'm not over there, thankfully. But if you look at that, it could roll into something bigger for sure. You know, you have China potentially. You know, you have the Taiwan issue. Also, you have the issue with China. Actually, a lot of internal turmoil going on that's not really as well publicized, but is definitely happening. So you've got a lot of unbalancing in the world. And to make matters worse, you have the global reserve currency, the U.S. dollar, which is set up to it's attached to everything. And we're going through a transition from raising rates to an inflection point of lowering rates. Now, the market has been assuming for the last over 12 months, so like 13 plus months, the market has been assuming that interest rates are going to start to drop. Actually, I think since the first rate rise that Powell said we're going to start raising rates, when they first started raising rates in 2022, I think it was, so when they started raising rates. Since the first rate rise, Wall Street assumed, oh, well, they're going to drop it next month. They're going to drop it next month, every month. They're going to drop it next month, over and over and over again. And they raised it from 0 up to 5.5%. And the stock market, every time, they're going to lower it. They're going to lower it in 3 months. They're going to lower it in 3 months, whole way up. And it kept there, right? It's still there. They're like, oh, they're going to drop it in March. I mean, some banking analysts said, oh, they're going to drop it 7 times next year. 7 times. I think one of them said 11 times. That was the extreme case. 11 times. They don't even have 11 meetings. You know, I think they're like 10 meetings. So, you know, the expectation of Wall Street was way out in left field. I guess left field's this way for me, but way out in left field. And, we've been saying on this show for a while that this is patently incorrect. The market has this wrong, flatly wrong. And the market is generally smarter than us two yahoos. I mean, we're just two, miscellaneous people here that have our opinions, but generally speaking, the market as a whole is a collective intelligence smarter than one or two people. But, to me, and I'm not the only one, I'm not saying Doug and I created this, like, we're not the only ones, but a lot of people that we know are saying the same thing. Like, there's no way this is going to happen the way people expect. It's certainly not going down 11 times unless we have a crash. And if there's a crash, it might go down fewer times because they speed it up and drop it quicker. So I think the reality is that the market is still pricing in that we're going to keep dropping rates. And lo and behold, we had a Fed meeting this week, and the markets didn't like the result, where Powell pretty much said, sorry, we're not dropping rates. Now, the January meeting, no surprise to anybody. But you're talking about the March meeting, now they're starting to push things out. Now it's not just, the 11. Now they're not getting 11 in. They might get 3. So people are trimming their opinions. But what does that mean? What that means is the stock market dropped. So we had a big down day on the Fed meeting. Yesterday was up. Today's a little mixed. But the market has to reassess whether they're accurate in their assessments. Now, there's a handful of problems here. First problem is that the market is expensive and it's pricing in that rates are going to be a lot lower. But are they lower? I don't know. Maybe they won't be. If they won't be, the market's got it wrong, and the market is way overvalued. Now, if the market has it right, you could argue whether it's right or not. I don't know. It depends on the interest rate. But for the moment, I'm looking at it and saying, you know what? The market's way ahead of itself. But I'm not the final arbiter. The price is. So we have to realize the price is the truth. Whether you like it or not, the price is the truth. And we all have our opinions about what the price should be. And here, Doug, can you mute a second? You're getting a lot of feedback here. Thanks. So, you have these, the price is the final arbiter. So I could think, and I want to use this framework really quick. A lot of people, especially bearish-natured people, which tend to be a little bit more cerebral, a little more intellectual types, they're like thinking through, like, this doesn't make sense kind of people. They have the intellectually strong case, but they're also frequently wrong. Now, this doesn't mean they're wrong intellectually. It means they're wrong according to price. Now, people have been saying Amazon, Netflix, Tesla, like you look at a lot of the big tech companies, people have been saying for the last 20 years that they're overpriced. And yet, they're some of the biggest companies in the world now. Are they overpriced? I don't know. But I know that when people have been saying it, they've been wrong for various different reasons, right? Is they end up, at some point, you'll be like, well, it did crash in 08. That's not what I'm talking about. That's a crash. But if you look in general, they're overpriced and they stay overpriced for various different reasons, which I don't want to go down this rabbit hole. But so the bears tend to have a intellectual case that sounds accurate and it makes a whole lot of logical sense, but it's frequently wrong because the market goes up 70% of the time and goes down 30% of the time statistically. So you have to keep that in mind. So right now, you look at the market, and the market's it's at all-time highs. As of right now, it is at least the S&P. I haven't looked at all the indexes, but a lot of them are all-time highs. Maybe it keeps going higher. And I know there's people out there listening to the show pulling their hair out. As you can tell, I've been pulling my hair out all day because I have a lot less of it. But if you're pulling your hair out thinking this is ridiculous, this doesn't make any sense, you're correct. It doesn't make any sense. The markets never make sense. Don't try to make sense of the markets. That's not the goal, right? The markets aren't going to make sense to anybody. And so when you're looking at the future and trying to look at your old crystal ball here, I need a crystal ball for my props. But if you look into your crystal ball and try to discern the future, it's going to be really hard. So getting back to my main point is this. Powell came out and confirmed what we've been saying on the show for a while. And if you've been listening to the show, you've heard it. If you're new, go back and listen to all episodes because we've been talking about this for a while. That the market has gotten ahead of itself. And this doesn't mean the market can't go higher. It doesn't mean anything. It just means the market's ahead of itself. And if you're expecting lower rates and that's going to help you, it's not. Lower rates are going to take a while. We've been talking about this for a while. What they say and what they do are two different things. I do not expect the Fed to lower rates in the near future. I would be surprised if we do more than 2 rate drops this year and 25 basis point rate drops. Now, if we have a massive crash, everything's off the table that I just said, because a massive crash means they have to drop rates. They have to, free up liquidity. It's a whole bunch of things they have to do, or they don't have to, but they do. You just assume they're going to do them. If we have a crash, that scenario is off the table. You have to assume that rates are going back to zero, and everyone go jump out of your first floor window, like just scream around like your hair's on fire. Like, that's a different scenario. We can't account for that, and we know that there'll be actions that will be above and beyond normal. But if we're in normal, they're not going to lower rates probably more than 50 basis points, I would say, at the most. I would argue that it should be where they are. If anything, they should potentially even raise them. Shipping prices are going up. You've got the stock markets at all-time highs. You have an economy which is stronger than anyone predicted. And Doug's in a minute is going to talk about the numbers that just came out today. But generally, like, it's much stronger than I predicted. Like we talked about 2 weeks ago, the power being wrong. I was wrong. I thought we would have a recession last year. It didn't happen. I'm predicting right around May's when the consumer funds are going to start to dry up, and that, I don't know if that caused a recession, but if it's going to start, that's a good marker. Don't know if it's going to happen. The economy is really strong. I mean, these tech companies came out, blew out earnings. They laid off a bunch of people, which means earnings are going to be stronger next time. So I don't know what's going to happen. It's puzzling a lot of really smart people. Of course, you saw what I did there. I put myself in the category of smart people, but it's confusing a lot of smart people, because logically and data wise, it's showing both a recession and also both as well as a strong economy. And that in itself is confusing people, because it's hard to see both. You're seeing one side, like 2 years ago when Biden came out and said, no, there was no recession. It didn't happen. Well, technically, according to the data, it was, although it's up to the government agency to declare it a recession. And I think if they were to do it, honestly, it probably was. But also there were signs where it wasn't. So if you took the non-data indicators, then it probably wasn't a recession, because the economy was still pretty strong. But if you look at the traditional data that they typically look at, it was. So I can see both sides. I'm not going to argue that's stupid, because no, I don't make the decision. But just keep in mind that what Powell came out and with this week is a really important comment, that looking at the markets, they've been up yesterday and today's a little mixed. If the markets keep going up, it's a sign that they still don't believe Powell. They still believe that he's full of it. Now, if the market keeps going up, there's something else to keep in mind. The higher it goes, the less reason there is to lower rates. If anything, it's a reason to raise rates. So if that's the case, you better be really careful about your portfolio, because the market has shot up since October, nonstop, and took a little break like end of December, beginning of January, but it's pretty much shot up straight. Be really careful, because if I can imagine a scenario where Powell comes out and says, actually, we're going to raise rates this month. That's going to be hard. The market's going to flip out. But the best thing they can do is stay pat. I think that's where they're going to be. Withstanding a big crash, that's where we're going to be. What do you think, Doug? We talked about a little data. We had some indicators here. What do you say?
Well, it's crazy. The jobs report came out something like 360. I'm not exact on the number here. I'm trying to pull it up, but not 370,000 or 380,000. They were expecting only 180,000, which is incredible. And we're talking 2-to-1 on the jobs report, which were expected. That is, the job. If you look at the S&P 500 mini futures, they're plump. They released a recent report tracking it is showing them plummeting right now, and it's all the reasons you just said. What we're talking about is an economy, we're talking about predictions, and Bloomberg has already, I think it's one of their economists already come out and said we're revising our expectations for the number of rate cuts. So they're publishing that already, which naturally all falls into exactly what you talked about. If what is, of course, Powell came out a couple of days ago and said, look, we're still looking at that 2%. That's our goal on inflation. We're not there. We've been saying this for months, but now what's happening is there's been a revision too of jobs data that has shown that in the first half of 2023, it was softer than expected, or that in pre-revision. Post half, better than pre-revision, and of course this great spike here. But I also, part of the data that I'm seeing, and again, this is almost comes into chart crime category, because part of what you're seeing behind the scenes on this trading, I'm sorry, on this jobs report, is that they are also reporting that this is some of the lowest average reporting that they've seen. So it's well below historic average reporting levels, which if again, not to get too technical in the weeds, but if you think about investing, okay, generally speaking, some of the most volatile times that you get in the stock market tend to occur during months in which there's less trading going on, there's less activity, because when you have less volume, every single transaction or every single occurrence ends up leading to a greater impact on the average numbers or the average results. So you'll see just one significant trade could have a much stronger impact on the performance of, say, the S&P 500 for that day. That's the same thing that may be playing into the equation here. So there's a lot of skepticism in terms of the revisions of these reports. But when you look at a little bit under the data, they're also getting less reporting happening. So if they're getting less data to compile in that jobs report, there may be a greater impact based on a smaller sample size of the information that was reported. Either way, this definitely creates the scenario of a pause here, because if you're trying to combat inflation, if the stock market, which has re-rallied after Powell's comments the other day and overtaken the losses, if you continue to have this hot stock market, if you continue to see that more and more people are being employed, if you continue to see that numbers and profits are getting blown out of the water, ultimately, at the end of the day, none of this says that there needs to be additional QE support. There needs to be additional money. There needs to be a lowering of interest rates to stimulate anything, because it's already hyper stimulated. So when, again, we talk about the 9 to 11 cuts. I like to joke at as the 457 cuts everybody was expecting this year, because it seemed like everybody was extremely confident in expecting that they were going to now be able to temper these things, because we saw mortgage rates come down. We saw some cooling of data. But now, as it's heated up again, this already taking what Powell had continuously said, it's like, look, until we hit very black and white numbers, I don't want to make changes. Now, we kind of did say going into the end of the year that he was starting to sound a little like Burns, maybe not Volcker. Maybe he was starting to give back a little bit and maybe waver a little bit. We came out in January and reversed that again, and was much less wishy-washy, much less soft, much less of a tone of, okay, maybe we might start doing something, which people took might start doing something as, look, he's absolutely capitulating. He's going to start doing this. He's kind of tempered that again. This data does not help that in the least. So now you start to see the optimism of these revisions and rate cuts, and you start to see a settling in of the fact that we still have a long way to go, at least at this point in time, on inflation. It's just basically making you and me look really smart here, Kirk. And again, we don't want to get ahead of ourselves here or fool anybody. But we believe very strongly in looking at the data and not trying to get emotional about it. The data, and not even the data, but the rhetoric at the end of going back last year and the year before has been very, very consistent. And there's always this argument that has continued to be addressed, which is don't fight the Fed. Well, guess what? 9 revisions. was definitely an expectation of fighting the Fed. Even if he was starting to Burns-ish capitulate, there was nothing in his rhetoric last year that said, hey, let's just start injecting capital into the economy again and lowering interest rates because everything's soft. Maybe a little bit of a softening, but definitely not. And this data only doubles down that, hey, you know what? Maybe we're getting ahead of ourselves here.
I love that you brought up the don't fight the Fed, and I want to kind of expand on that a little bit, and I want to get back into some other stuff. But the whole concept of don't fight the Fed is an example of I just talked about the perma bears who always think it's bearish and things are going to go down. And intellectually, it's sound, but in reality, it doesn't play out that way. Perma bulls have their own version, right? And the perma bulls are the same. They always think that the Fed's just going to drop rates and hyper stimulate the economy. It's just going to go up forever. And so most of the bulls are perma bulls. They think it's going to go up. Now, 70% of the time they're correct, but they also miss all this data that they're like, oh, they fall into the buy and hold crowd. I'm just going to buy and hold forever. Like, well, yeah, that works until it doesn't. And I mean, if you're putting all your money in now, and let's say we have a stock market that goes down and doesn't come back for like 15 years or something, well, you're going to feel pretty stupid, right? Like if you're not doing any risk management, then you could get yourself into trouble. So you have to, we don't talk about this enough in the show, but you have to really you have to do some scenario based thinking, right? So you can't just look at, well, the market's going to go up, and if it doesn't, I'll just wait. That's not a strategy. That's hoping. Hopium, as we call it, right? You're not going to, the hope is not a strategy. So the better way to do it would be to focus on, all right, so one scenario is the market keeps going higher, right? What am I going to do? Another scenario is, well, the market's just going to bounce around here like it has been for the last 3 years. Okay, that's another scenario. Third scenario is the market drops to whatever degree you want to, deep water test that. Okay, the market drops. What am I going to do, right? And then you have to really look at really bad scenarios. What if the market drops like Japan and doesn't come back for like 30 years? What are you going to do then? I don't know, but you have to have a strategy. You have to have a plan. And so if that's the case, all right, how are you going to handle that? At what point do you admit that you're wrong? And this is actually, that was kind of the point of the episode 2 weeks ago, which is I was wrong. The point is you have to throw your ego out the window. Hopefully your body's not attached, but throw your ego out the window and really have to look at it and say, all right, at what point am I going to consider my opinion wrong? Like at what point? There's a point. Is it 0? Right? If it's 0, it's probably too late. But like it's at 100. Is it 95? Is it 90? Is it 50? Like, I mean, 50 is okay if you make that decision ahead of time. Like some people invest in like highly volatile tech stocks, or not tech stocks, but like mining stocks or some crazy stuff. And you could see like 50, 70% swings. Crypto's a perfect example. It goes up 3, 4, 500% and goes down 70%. If I know that's normal, then when it goes down 70%, I get really greedy, right? And say, this is a good time to get in, right? But if it's already up 500%, I might look and say, maybe I should take a little of the greed off the table and wait. Up to you. But as long as you're comfortable, you have to understand what that looks like. So I love that strategy. But the point is the don't fight the Fed is always used for perma bulls. Oh yeah, don't fight the Fed. It's going up. I'm like, okay, what about when then the Fed's raising rates? I think we're the only people I've ever heard say, don't fight the Fed when the rates are going up. Don't fight the Fed. And yet they're like, that doesn't apply here. Why not? It works both ways. Anyway.
Don't fight the Fed means don't fight the Fed, period.
Yeah, people are crazy, Doug. I want to talk about 2 pieces of important news this week, and then I'm going to get into a third one, which is a little bit more also important. So the first piece of news this week was Evergrande, a Chinese property developer, a Hong Kong court ordered Evergrande to liquidate, saying you're bankrupt and you need to liquidate your assets. Wow. I don't know if that is a good thing or a bad thing, but I'm pretty sure Xi Jinping is not pleased. So we talked when I talked about earlier in the show, like China's got some issues. China's got a lot of issues right now that are kind of being swept under the rug, and I don't blame them because every country does this. But they have some particular problems right now that they don't have great transparency over there. If you can imagine, worse than the U.S. And they were forced to liquidate. They had some problems last year. It was kind of swept under the rug a little bit. They were supported. China's gone a long way to make sure that their property market doesn't crash. But the cracks are very visible in the Chinese economy right now. I would not touch the economy with a 10-foot pole, because what tends to happen, some countries more than others, is when things get rough, they go to extraordinary extents to keep things together. I think it was 2-3 years ago when the Chinese government basically started to crack down on entrepreneurs, taking too much of a mouthpiece role against the Communist Party, and they started to disappear for long vacations. Probably go to re-education camps would be my guess. But if you're looking at stuff like that, that's not the. I think that's when the stock market kind of went down and hasn't come back because people are just like, I don't trust that market. You shouldn't. The way that the top down approach is a little scary as an investor. I wouldn't touch it. I think there's more downside to come in China. Another story, which is similar but different, is the New York Community Bank Corp got crushed this week. I think it was down from somewhere around $10 and change down to like $6.50. It got crushed, and I believe, Doug, didn't they take over one of the failed banks last March? What was it, Signature Bank? They took over.
Well, the way I like to look at this, Kirk, is that there is a superhero by the name of Superman, and they swept in last year with the big S on their chest, with their big red cape, as a Superman that was saving Signature Bank, which was a disaster. Unfortunately, what they've now turned into is Greatest American Hero. And if you remember that show, a little plug for the 1980s, one of them does a much better job landing. Let's just leave it at that.
It's a scary thought that, and I'll bring this up for a few different reasons. It's a scary thought that taking over another failed financial institution and you start failing, those other assets must have been horrible. Like, I mean, not, because you have to assume at some level that when the government is kind of directing, or the FDIC is directing these takeovers, it's, hey, let's take it into safe hands so this doesn't waterfall into more failures. Because we started to see that in 2008 when AIG and Lehman Brothers and Bear Stearns, and like they tried to stop the waterfall, with a few different measures. But I mean, that's why, companies like JP Morgan are so attractive as a, hey, why don't you take, like you're basically having the Fed call you up and be like, can you acquire this company for us? I don't know what was said, but I imagine that's what the conversation was. Hey, can you do us a favor and take over this failed bank? And when you see the sweetheart deal they get, and those of you who go back and look at the terms of like Lehman and Bear and all the other firms who were taken over at that time, you had Merrill Lynch, went to Bank of America. Like all of these takeovers were under like ridiculous terms. Like, yeah, we'll take over all of these assets and not these. We want a guarantee. So if it fails, we get a guarantee from the government. Like all this extraordinary garbage, right? In order to take over these assets. And hey, they're bankers, they're negotiators, so they go negotiate themselves a good deal. I don't harbor any resentment for that. But I will say that, when you start to see a firm that took over a failed firm start to have problems, it gives me pause about, remember we talked about in the show before where it's, isn't that interesting? That's all I'm going to say. I'm not saying that New York Community Bank Corp's bad, or I'm not even going to characterize the trade because we're not giving advice. I'm just going to use this as an example. And as you look at this, and let me just share the chart for those of you who are not technologically inclined, myself included. Come on, there we go. And if I'm looking at this, that doesn't look good. So it's isn't that interesting? That's all I'm going to say. And I'm not going to characterize the company, but more just the chart
Well,
of like, as a bank, are we headed for more problems in the banking sector, or is that it? Don't know.
well, I want to add something here. First of all, if you want to put that chart up again for a
Hmm.
second, I think it's very interesting that their stock price is back to where their stock price was during the banking crisis of 2023 when they ended up acquiring the share of Signature Bank at or around that time, right? So that's not a good sign. The other thing too, and I've said this um, in other conversations that we've had on one of our other broadcasts, we there was a lending program that the Fed set up back in that March timeframe of 2023 in order to basically create liquidity for these banks to be able to borrow from in the event that they have a liquidity crisis so that they don't have to fall into what is now, which prior to that was an immediate fail. When we hear bank failure isn't just because the bank decided to show up someday and go like, you know what, we decided we're going bankrupt, we're shutting down. It is a very rapid occurrence that comes from when regulators need to come in because there is a situation in which the liquidity needs of being able to provide the cash to their clients is no longer be able to be met by the liquidity reserves that are there. So and all of a sudden you get and this is again, it's a wonderful life. You get into to where all of a sudden they need their money out and the bank can't fit it because they've got too many assets, liquidity. And if they were to sell those assets to create liquidity, boom, bank's in trouble. So that's when the Fed comes, not the Fed itself, not the Federal Reserve, comes in and basically says, look, we're going to take this over. We have to. You failed. You have not met these requirements. Well, so they created up this lending program to basically alleviate that pressure and say, all right, if there's a need for liquidity, we will lend that money to you to give you basically it's like a reinsurance of that cash to minimize these bank failures. That is coming to expiration. I forget exactly the date of when that's supposed to occur, but this was not a permanent solution. It was not a change to our banking waterfall industry. It's temporary and it's coming, and it is going to be coming to expiration here in the next couple of months. So unless they extend that program, situations like you're looking at with this bank are now poised to become a serious problem.
Yeah, it's it's just something. Come back to it. It's isn't that interesting? I think it's just kind of one of those things you just got to keep an eye on. And like Doug said, isn't it interesting that's back to last year, similar time, in terms of price. It's just something to watch. It could be nothing. You got to understand banks are insolvent by their nature, right? And as long as people don't pull their money out, they're fine. But as soon as they start to pull their money out, that can have a run on the bank, and that can be a problem. So, you just have to be cautious. Just be aware where your money is. And if I would never put all my money in one institution, because if it goes bankrupt, you could be out 6, 12 months without the cash, and you got to make sure that you're protected. So always look at the potential risks, as we're in a time where those are possible. Now I want to share this other chart too, and then I want to get into housing, because that's
And I want to add one thing to this. I thought this was humorous, Kirk, is that somebody actually because since we're talking about bank failures or failures, going back to the China comment.
mhm.
Somebody actually posted China is the true example of pure capitalism, which of course is a laugh in itself, right?
Yeah.
But what is China doing right now with Evergrande? They're actually letting a business fail. When is the last time the United States actually let a major business fail? We've almost become the country that doesn't allow for capitalism to run its course. So I thought it was an extremely humorous irony there that's China is doing what capitalism should do in this situation.
Yeah, I mean it's sad. I mean, we haven't had capitalism in this country for a long time. True capitalism. I don't know that true capitalism actually exists in the world at the moment, but there was a time where it was maybe. I think about that when people think, well, back in the olden days, because that's actually a cognitive bias that we have. Well, the olden days things were better. I'm trying to think back. I'm like, I think it's always been this way. It just wasn't as visible to us. There were always this back deals that were going on. I know I used to live in Beacon Hill in Boston for a number of years, and my dad told me this story because Beacon Hill is all brick. Sidewalks are all brick. It's beautiful. Like, it's part of the charm. My dad told me the story back in the day. The reason it's all brick is actually because one of the politicians had a buddy who had a company and they had a lot of brick and they couldn't get rid of it. So he contracted his buddy to brick all of the sidewalks. That's why they're brick. It's not because it was beautiful or traditional. It's just some back end deal that some guy paid off another guy to do. I mean, it's just crazy. That's how stuff gets done. So I'm not sure that's ever changed, but it is interesting to note. I do want to share this chart and then get into real estate, because real estate, Doug has some pretty good charts. So I saw that. I mean, this is the Manheim used vehicle index, and I don't track this that often, but I saw this on one of my clips the other day. And what's interesting is, as you notice, like, over time it goes up, right? It's just nature of cars; they go up in value and inflation and all that. But if you notice, during COVID they spiked, and these are used car prices. So if anyone remembers, you couldn't get a used car during COVID, and people had a lot of extra cash, nothing to spend it on. They had there were not enough cars because you couldn't get the parts. So once the cars were sold out, like, I saw a lot of new car dealers where there were no cars in the lot because everything was sold, and they couldn't get new cars because they couldn't find the chips or the semiconductors, whatever they're doing. They just couldn't find the pieces to really construct a full car. So there just weren't enough. And when that happens, supply and demand, there's not enough supply, demand is the same. That means the price rises. As you can see here, went from 140 up to 260, and now it's back down to 200. So it's receding, and I imagine it's going to keep receding, which means it's probably going to go another, looks probably from around 200 to maybe like 160. So that's another 40. So you got, what was that, another 20%? So you get another 20% down approximately, maybe even more, depending on, it usually has a reversion to the mean, which means it's usually, it doesn't go to the line, it goes below it. So we could see further downside in used cars. I'm actually looking at that as an opportunity. I think it'd be a great opportunity to buy a new used car. So if everyone's looking, be patient. I think you'll start to see some things come up. And I also want to point out the next one. And used cars are actually an indicator of the economy, so just something to keep in mind. I do, excuse me. I do want to keep in account. I don't know if we'll have enough time to talk about all of it, but there's. Doug sent me this. Doug, do you want to talk about this one? This is really good. The home affordability index for the last 50 years. You want to talk about this? Because you sent it over. I thought it was brilliant.
Yeah, absolutely. So basically, and we've talked about this a number of different times. So what it's talking about is whether or not the income that people generate in their household can afford to manage the payments of the housing that they have to purchase. And of course, that is tied to a couple of different variables. First of all, it's obviously tied to where income is, and has incomes been rising, or have they been, stagnant or going down? Now, we have seen incomes rise. We actually saw, just to kind of go back to the beginning of this conversation, there was, I think, a 6% increase in wage growth, which was incredibly strong. Again, another very bearish data point for those that are expecting rate cuts, by the way, because wages, not only are people getting hired, but getting paid more. So income goes up. Now, on top of that, it's obviously going to be the price of the entity you're acquiring, because the larger you acquire, and this is taking into consideration 20% down payment, which is fairly standard. And then what is going to be remaining of the amount of the balance of the mortgage that's going to need to be managed and paid for is obviously going to be tied to the value of the property you're buying. So the higher the valuation of the property, the more you have to take on in debt. But then add on top of that, of course, interest rates. And when interest rates are higher, then that obviously takes the amount of debt that you've taken and changes the amount of the payment that you have to afford, which of course is where it directly impacts against cash flow. And what this is showing you is that underneath this metric between 1970 and 2023, there have been only a handful of times in which the home affordability index has been less than 100. Okay. So for the most part, housing has been fairly affordable, at least based on wages earned and the cost of managing the cash flow of that debt. In 2020, you look at how, I mean, as a matter of fact, 2012, not probably surprising to a lot of people if you think about what occurred after 2008 and the real estate, and mortgage crisis. It became arguably the most affordable time frame since 1970. Okay, because because in this situation, interest rates on the housing hadn't significantly dropped, but the valuations of those houses had significantly dropped. So you might have a more expensive loan to maintain, but you didn't have to take as much of a loan to get those properties. When you combine, now you go into 2020, what happened there? Housing prices had skyrocketed, but interest rates had been systematically cut down to 2.5%. So the larger the debt you could take, the payment was staying the same. Okay. Now, what do we have here? We have something very similar to the stagflation era of the late 70s, early 80s, when interest rates were high, wages were under pressure, cost of acquisition was up. What do we have today? We have interest rates that are up. Yes, they may have settled back to 6%, but 6% is still 4.5%, 4% greater than what they were 2 years ago. And that we've shown the numbers on previous conversations. That translates to hundreds, if not thousands of dollars more per month to maintain. On top of the fact that housing prices continue to be at least stagnant due to the very skewed supply versus demand. There is no housing availability out there. And what is available is still being fought for by those that can. So it's keeping prices up. We've got people that are stuck in 2.5% mortgages. Lots of reasons why there's not a lot of home inventory. That means that the prices have been made hot. You got to take a large mortgage to get these, but now you're still sitting at 6% interest rates, so 2 to 4% greater than years before. We are at one of the since 1970. So we're talking 50 years, 2 times in which home affordability is absolutely strangling the average consumer.
Yeah, it's it's interesting because I find myself in a similar boat where I look at the numbers and I talk about it in the show. Like, we're renting. We left the city, we moved to the burbs in the middle of COVID, and we weren't ready to buy because we still had another place, and we finally sold it. But we're here and looking at the prices, and it's crazy. And like, I can't. We're an expensive part of the country anyway, but like, just looking at these numbers, the home affordability, it's so true. In rates have come down a little bit, but real estate prices really haven't. They've come down a little bit, but like, we talked about a year ago on how the affordability was like, real estate would have to drop like 40 some odd percent, or rates would have to drop down to where they formerly were to become, I would call, to get back into an equilibrium. So I try to think of things in terms of an equilibrium, because you can sit here all day and say, well, the PE ratio of the S&P should be 17 and it's really like 23. You say, well, it should be 17. I don't know where it should be. Like, you could do all the research and, back office fundamental analysis you want, but the reality is, like, you don't know, right? So I like to think of things in terms of equilibrium. So where is the equilibrium? Where is the market saying that this is a reasonable price, right? So prior to COVID, the reasonable price was within a range, and it was on the more expensive side, but it would, you could make the argument that there's reasons for it, not enough supply, whatever it was, right? But wherever it was, it wasn't like a 2007 or 2005, I think was the peak. It wasn't like the 2005 real estate peak where you knew it was a bubble. Like, a 5-year-old knew it was a bubble, and they were still doing it, but they knew it was a bubble. This is a little less clear, and in the last few years. And so when you're looking at at the chart that we just showed, the affordability index, we're still at unaffordable levels, and I think the challenge is people are going to get slowly milked of the money. They're going to get drained dry, and then what do they do? What do you do then? Like at that point, how do you manage that? It basically, the way is you just never move. You just stay in your house and you never move, which, for some people might be fine, but if your house is fully paid off, you don't care. And there is a large amount of population, I think it's 30 or 40% has the house fully paid off, but most of us don't. And then I look at the numbers and say, well, what does it cost me to rent versus what does it cost me to buy? Well, it costs me a hell of a lot more to buy than to rent. So why would I buy? And I know there's an emotional component here, but it's just something to think about. Like, why would you put yourself in a position where you could get, taken to the cleaners in an environment which is not obvious? Now, if the Fed drops rates to zero, I'd say, all right, full speed ahead. Buy any asset that's not nailed down, because that's basically the strategy. I don't think it's appropriate, but that's what's going to happen, right? Is they're going to say print money, rates to zero, go all in. Like, that's the strategy. We're not in that environment, but people still pretend like we are. And I think that's the challenge that people have to be cognizant of. We didn't have enough time to go into the real fun topic of water today, but we'll probably do that next week. So, Doug, final thoughts and take us home here in the interest of time.
Yeah, I mean, you mentioned something about 30% of the families having their house paid off, and they don't have to worry about that. But at the same time, part of what has been the takeaway of this is that the rising housing prices have led to municipalities who are looking for more and more revenue, raising the cost of taxes. I mean, taxes never go away if you're an owner. And so, again, talking about renting, I mean, I'm obviously not going to put out to the world any kind of detail as to kind of what your affordability is and your financial situation. But I think we could probably both sit here and say, Kirk, that you and I are privileged enough to be in a fairly well-to-do financial situation, as opposed to the average of what it is to live, for people working in America. And yet you're still sitting there saying, look, I'm looking around me saying it's tough to buy a place and affordable. So what does that mean to the average household? And then you take a look at, not only the cost of acquisition of getting these homes, you take a look at all of the other things that go on. So maybe you don't sell, but what does that do then to the supply and demand of all of the goods and services that are necessary in order to be able to maintain and keep your existing house functioning? All of these things have risen, and they're all, like you said, bleeding out the system. And that is exactly what Powell intended when he raised interest rates, to stop and combat inflation, is to slowly bleed out all of this excess M2 capital. And now you start adding in things like college expenses, like Gen X coming up against colleges that have actually been tame in terms of recent inflation. But if you look over the last 20 years, you're talking colleges that were $20,000 now costing $70,000. And so one kid, you're looking at maybe $280,000 to put that kid through school if you're not figuring out and managing the cost of what of the education that they're going to be looking at. That's $500,000 plus out of your pocket for two kids. It doesn't have to be that way, which is a good segue to find out more about how to effectively pay for college, not get fleeced by it. Maybe control one thing in your life that is going to be a significant drag on your wealth today and in the future. Then get the information you need on that, because there are ways to navigate that system. There are ways to even the playing field on that game. And if you want to get more information, you can find out more at procollegeplanners.com. procollegeplanners.com. You can download our free checklist, what you need to know. And also for 5 minutes, you can download a free report and actually get an idea of what college could cost for you and where you could save some money. Listen, 5 minutes is worth your time to save, tens of thousands of dollars. That's up to you, but go to procollegeplanners.com and learn more.
Awesome. Well, Doug, always appreciate you coming on the show. We're going to wrap it up here. So that's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name is Kirk Chisholm, wealth manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on the show. Please remember to subscribe to the show on the podcast app you're choosing. You can also check out the show at moneytreepodcast.com. On the website, you'll have access to the show notes, resources, and the archive shows. Also, we're now on YouTube. Please check out our YouTube channel. When you're there, please subscribe and leave a comment. Lastly, please leave a short rating and comment on the podcast app of your choice. Oh, and don't forget, do your own research. This show is for information use only. We're not telling you what to think, merely how to think about investing. We're also not selling any products or services, so do not consider this advice. If you have any problems with the show, I blame Putin. Please send me an email, express your feelings. If you're seeking financial advice, talk to an oracle or a fortune teller, or maybe just a licensed financial advisor. I'm one. As I said earlier, I'm not selling anything, but I'm easy to find. One quick thing, just a shout out to Steve. He asked me to do a shout out, and no one ever listens to these, so they probably won't even hear it. But anyway, have a great week ahead, and remember, no one will care about your money like you do. So invest